I'm Stephanie Link. I'm co-portfolio manager of Action Alerts Plus. Jim Cramer is here with me. We want to talk a little bit about our technology positioning in the fund because we've made some big changes. We went from underweight the group to overweight the group and have 2 new positions in the fund.
Now, typically during this season, beginning with the Goldman Sachs technology confab in February, I've always wanted to scale back tech because I fear summer slowdown. But it's different this year.
Well, because we didn't get the fourth quarter budget flush, right? So normally we get that. IT budgets have been really problematic all of last year. They're still sluggish right now, but we think that maybe in the second half of this year we'll start to see an improvement as we get through fiscal cliff and sequestration and debt ceiling, all the uncertainties.
Now, we went back to EMC, and I'm sure that's probably confusing to people, but the market's up dramatically. EMC's done nothing.
Down 4%.
Down 4%. And basically what's happening is that a lot of what was true is finally playing out. Big data is playing out. VMware seems to have stabilized. Obviously, they own a huge chunk of VMware. So this is not as risky as when we owned it last time.
Yeah, I think a lot of the bad news of the VMware and the slowdown is in the stock. The company, EMC, one of the reasons we sold it was we were worried about the guidance.
Right.
And the guidance actually turned out to be 8% organic growth for this year. Not so bad, not so horrible. Now, could that expand going forward if we do get the budget flush, if we do get businesses to spend
or
again?
gross domestic product being a little better?
That's right. So this stock is very cheap. It's always pretty cheap, but it's historically cheap by about 3 to 4 multiple points relative to its historical range.
It's a much faster grower than that multiple indicates.
Right, terrific. So that's the first one. Oracle, real quick. That one we actually have owned in the past, but we got back in.
Well, Oracle's been a big net winner of Hewlett-Packard's problems, right? It's also, Oracle never skipped a beat in Europe, which is rather shocking, and yet they haven't gotten a lot of credit for it. This is a stock should be at 40, given what we already know. They are still taking share. They're still doing a great job. I do like Salesforce.com, but it doesn't have to be mutually exclusive. And Salesforce.com is a ridiculously high multiple versus Oracle, which is a much lower multiple than it should be given its growth.
And I think it's because they haven't been able to make money in their hardware business.
I think that's absolutely right, but I think that's now amortized.
That's right, and if they can do that, if you can see any kind of improvement whatsoever, I think you do get multiple expansion. So we're not counting on that. You don't need to count on that for the stock to get to 40, but to get beyond 40, I think that's what you need.
And what really matters here, as we know, is that tech has been seriously undervalued and left behind by the Cloroxes, left behind by the ConAgras, and yet they have better, superior growth right now. That's what people are going to rotate back to, and they're going to rotate back to big EMC and Oracle.
Thanks, Jim. I'm Stephanie Link, co-portfolio manager of Action Alerts Plus.
For more on Jim Cramer and Stephanie Link's stock picks and investment strategy, go to actionalertsplus.com.